Kalispera Anthropos, welcome to Economica, all about economics and finance. And yes, it's been a long time since I recorded the video, and I'm so happy to be with you all today. I've been very busy doing a lot of things, but yes, I decided to publish something on video for a variety of reasons. Of course, I'm going to share with you all my humble research on the UK inflation data. Because we have the economic calendar, we know that every day we have macroeconomic data, and so I spent quite some time take all the data series and to find out about how is getting on the overall picture of inflation in the UK, which is a macroeconomic framework that I've been studying for quite some time in detail, which is very interesting and truly informative. I've learned a lot of things on my own. Nobody taught me anything. I've applied macroeconomic models by my own self, and so I've decided to share with you my Nowcast model, which is by no means perfect, but in simple terms, we'll try to familiarize and see what are the more or less the dynamics of the of inflation, why we have this Hormuz Strait crisis, this high and persistent energy prices. Oil, heating oil, gas, fuel, petrol, so forth and so on, and why we haven't seen a sharp steep rise in inflation. That's thankfully we don't have 6, 8, 10% CPI, but it's pretty much contained. And the latest data point of if we today we have we can observe the Canadian inflation rate, and we see that the previous data was 2.8. In July, it came up to 3%. So there is an overall trend globally, which is feeding through the pass-through effect. It's feeding through the main inflation basket statistical measure. And we can see that slowly, by 0.1, 0.2%, every month there is a steady increase, which is making deviate again the inflation level, or the level of prices or of certain prices from the phantomatic 2%. But let's forget about the 2%. Let's say the inflation is going up again instead of going down. Instead of having prices normalizing or discounting and decreasing, we have some prices, some baskets, some parts in the economy where prices have gone up. Notably, the retail prices which have been affected the most are, of course, petrol and fuel at the pump. So when we go to the petrol station, we notice a sharp rise, a huge jump in diesel prices or unleaded prices. Those are determined by well-known facts that most of the refinery capacity production and the supply of refined products have been hampered and damaged, and so the capacity in aggregate has diminished vis-a-vis the same level of demand, which also has been decreasing. We have the first data from the United States where the consumption of petrol or gasoline has diminished because we have some crazy prices, like of some parts, like in California, there are people they have seen $6 or $7 at the petrol station, and so I can share with you what comes from the. So Wednesday we will have the UK inflation data with a raft of other data. And on Wednesday there is also the ECB Lagarde president speech, which is no policy meeting. We will have also the inflation data from the Eurozone, but the interest rate policy meeting is from ID, I think it's Indonesia. Best of luck for the earthquake in Indonesia. So these are that's my table of data of many UK inflation baskets. So let's call it like that. And when we go and see exactly the data column that tracks the fuel and petrol. I think it's this one. Yeah, I see. Okay, yes, exactly. Okay. Okay, so I hope that I can share with you a decent format of this thing. Let's try to plug up a chart. Yeah, okay, here we have it. So here we have the RPI, so is the retail price index. It's a month-on-month data, but it's an annual percentage change. So what we have here is the tracker of petrol and oil prices, fuel. You can see by yourself that these prices have spiked a lot, 29%. So the biggest round effect of the energy crisis, of the supply chains and the refinery capacity shrinkage, it's felt directly at the pump, the petrol station. So these items are the most affected, and anybody knows that because in Europe we have diesel prices which are higher than petrol, than unleaded, and we have some prices in the highway which are €2.50 per liter for diesel, while petrol it can be €2. So we see empirical data of very high prices, unusual high prices for fuel. The same issue is for domestic heating oil. So all people who have live in rural area and they need heating oil, which is a byproduct of diesel. It's in the same refinery process. Those prices also have increased, and this basically generates a pass-through effect on household bills. That's why it's actually interesting, but it's actually very real, because I have here the data columns of you see here CPI annual rates, housing, water, and fuels, and electricity, gas, and other fuels. So if we scroll down to the bottom, we have 1.2% for housing, water rates, and minus. So some other measures of CPI, they have gone from positive to negative. But if we see here, in the previous months, we have some jumps of 6.7, 6.7, 6.8, 9%, 9%, 9%. And the same is for housing, water, and fuel. We had jumps of 7% every month. And these are exactly, okay, so it's April 2025. Yeah, April 2025, 7.8, May, all 2025. We have 7%, 7.5, 7.4, 7.4, 7.3, 5%. And finally here, it's decreasing. So most of the pass-through effect, it has happened between 2025, paradoxically before the full-scale blockade of Hormuz, and it has followed through in the first 2 quarters of 2026. And now we have seen some deflationary or decreasing effects of for what concerns the household bills, water rates, gas, fuel, electricity, pure basic utility cost. And as we have seen up to now, the biggest jump, it has happened for petrol, oil, fuel, so forth and so on. So that's why in aggregate, what happens is that we have not seen a so great effect on overall CPI, Consumer Price Index, the inflation headline number that all people get from the telly, because it's in specific parts that are more linked to household utilities, gas, water, electricity, and fuel. So driving a car, using any vehicle, where is heating oil for domestic use, all those prices have increased a lot, not only recently. The pass-through effect has started in the second quarter of 2025, so April, May 2025, And anybody can see that through the ONS website that the increases here in the jump in housing, water, and fuel CPI annual rate has been of nearly 8% every month for a sequence of months, which is, we can count it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months back to back. It's April 2025 CPI annual rate, housing, water, and fuel. Okay. And specifically, the base price here is 2015. So compared to the base price in 2015, what has been the month rate of change on an annual basis, we see that in April 2025 was 7.8%, 7.7, 7.5, and so forth and so on, for 12 months up to March 2026. Thereafter, we have these data which are lower than 2%, around 1%, but still positive. And CPI was pretty much contained because CPI is a basket weighted measure, so there is the whole thing together. But households bills, fuel, petrol, heating oil, it's exactly true and correct what the average the average households in the UK has experienced in paying utilities. They have increased a lot on a straight 12 months back to back from April 2025 up to April 2026, full fiscal year, full gas on housing, water, and fuel, electricity, gas, full gas, 6.7, 6.7, 6.8, 9%. These 3 months, we are near, 9%. So July, August, and September of 2025, so past summer, the year before, we have 9.2, 9.4% per month of full gas on the throttle, CPI annual rate, electricity, gas, and other fuels, which include heating oil in that particular index basket. This is almost 10% every month compared to the year before. And these are huge rates of increases, of hiking prices of utilities. These are very large. These are way not normal things. And that was 2025. It's not even 2026, when now we see that they are negative. So there is something a little bit strange, in effect, because we should have 10% now, perhaps negative in 2025. But these are specific of what is the UK utility providers, what is the British Gas or Southwest Thames Water or all that kind of stuff, Octopus, all those things. I have no idea. I don't know all of them, but Ofgem and Ofwat and so forth and so on. But these are really high, and it's true that households, they have been whacked on a 12-month straight full gas bills. The cost of utilities, household utilities, have increased a lot. And but these have not gone through fully into the inflation headline, which is 2.6%. If we see RPI food, we have food, it's declined a lot to 2.3%, which is more or less an acceptable inflation rate. So it's a mixed picture, and what concerns the most are, of course, the derivative products, the refined products of oil, which is petrol, fuel, heating oil, and then all that comes around with supply chain, which is gas, electricity, and water. It's a major, another major issue. So what we can expect, we have that inflation rate was 2.6%. We have some signs that the PPI, which is the producer price index, which is the price that the UK domestic producers have to absorb, whether it's domestically produced or it's imported from abroad, from outside the UK. So we see that the input cost has increased to 7.3%. That was the month of June. Now, not all imports are more expensive than the exports. I have the table here. UK. I will share with you. It's a bit the way this table it's made. It's really not useful, but I'll do my best to explain. So to navigate with you this thing. So this one FSP7 are, for example, I'm picking and choosing because the way the data it's the Excel table it's made, it's absolute garbage. But so to not make things difficult, we go to description, we see, for example, this is the table of all the producer price index input. So we have here the acronym, what identifies the time series. So FSP7 are input products groups, inputs of food, domestic, while FSP9 production group, inputs of food, imported. Now, when we go on the index page, we see FSP7 is domestic produced food in the UK. And we see here, this is the index value, and E column is 1 month, F column is 12-month rate. So we go back down again, okay, just for this. We align to 2026, okay, 2026. So what we see here is exactly the same dynamic that we have seen with the utility bills, that the inflationary period has been here, 2025, but for FSP7, which is FSP7 is inputs food domestic, P9 it's imported. So for domestic food producer price index, we have 2.7, 3.8, 2.3, 2.5. These are February 2025, March, April, so all 2025, yeah. Here, and here we have the this is the latest period. These are the yearly producer price index data, and we see that these are 1.6, 2.7, 3.8, 2.5, then 4% that was in the highest inflationary months were July, August, September 2025. We have 2.8, 4.3, 4.2, 4.1, 3.5. These are the producer price index or P7 domestically produced. If we compare for the same period of imported food, which become an input for production in the UK, so we scroll down, we take the FSP9, this data table is absolute garbage the way it's put together, and you see here that these ones are way smaller, they are negative. So imported food, paradoxically, whether it's on a yearly basis or on a month percentage change, they are negative, they are deflationary for what concerns the overall input cost that UK producers have to absorb. So food imported into the UK is cheaper than food produced within the UK. Okay, so when you hear all people who don't know the data, who don't spend time to go and check the data and say, okay, we import stuff, we pay more. No, it's not always true, because food imports, they are cheaper. They have a deflationary effects on the overall producer price index. Okay, minus. These are all deflationary. And in that, there are imports that come from Europe as well, which they are hopefully less expensive than UK produce, because they can help contain the cost of food production. Now, this is only a little example, because here we have the input for anything: manufacturing, fuels, inputs of parts, equipment, alcohol, textile, chemicals, anything. So we cannot go through everything, but remember this one, FSP7, domestic food produced, FSP9, inputs of food imported, they are deflationary net compared to domestic inputs of food production. So not all things that are imported in the UK, which are offered on the market for UK producers, they are some of a bad thing. They are cheap products which make production actually less difficult. Okay, so free markets, free commerce, they are a very good thing, because we can source products and we can find cheaper inputs. If you run a business and you have to be very much considered of the running cost of the business, how much it costs coffee or vegetables and so forth and so on. You want inputs that are less expensive. Okay, so what do we have here? On one side we have the modeling, the yodeling, okay, here, okay, which is running a little bit. Now, what we will see the quickly, we will go through the univariate forecasts, which are the ARMA and SARMA models, which basically they take the single data column, the data input, and they basically spit out the what the ARMA model does. It goes column by column, okay? It analyzes all the CPI data month by month, starting from 1989, January 1989 to the latest data point, which is June 2026. It does this for all 21 data columns. So it's a large data set, okay? These are 450 data points. And it's univariate because it's just one variable at a time. It goes through all the past data. It checks out whether these data, they are correlated with each other across time. It tries to normalize the data, eliminating the noise, using a first difference or a second difference method. And then it spits out your forecast, which is more or less, it can be more or less precise. It's not absolute certainty, and it's very easy to understand because the pink shaded area is the confidence interval. So you can see that the range interval is quite large. It's large because it's a bug in the system. Because the code it's reading 95% as the whole confidence interval. If I put 5%, the shaded area will be much, much smaller. It's just a code bug. So okay, so CPI, we have that it should be around 2.5%. Okay, let me zoom it out. It should stay here. Now, these forecasts, they are, as I said, univariate, so it's just one variable. It's only the inflation data. There is no other shock that we inject onto the thing. So it does not give a damn about what's happening in the Strait of Hormuz, what's happening in the petrol station down your block, so forth and so on. So in normal circumstances, nothing changes. There is peace in the universe. So we have 2.5, 2.8, 2.6%, 2.7%. Still, it will be above the 2% inflation Bank of England target, which is a false target. Then, if we have this other CPI, which has a 2015 base year, so comparing to 2015 prices, let's say, we have the same. We stay around 2.5%, 2.6%. Okay, so inflation should not vary a lot, but even in normal events, I don't have inflation going below 2.6%. Okay, so this thing, it can be precise, less precise, but it just provides to me a rough idea, a broad idea, or a range of possible outcomes. Okay, so same for core CPI. We strip off energy, food, and alcohol, and so forth and so on. We are around 2.5%. Okay, this one is a little bit lower. We have a possible range. So in the lower bound, we can have core CPI that drops to 2 and 1.5%, or we can have a rising CPI above 3 and 3.5%. There is a range, but the range is it's a bit large. It's too large. I don't want to consider it. So here, housing services should stay around 3.3%, around the 3% level. Housing, water, and fuels. Now, this series is non-stationary, and what it means, you can see in the jumps, it's like a step function, step up, step up, step up. It's not like a curve or a bend or something. It's just straight line up and down. It's like a staircase or something. So this one, it needs to be treated a little bit differently because it's a jump, and so that you have to account for structural breaks in the sequence of data. But anyway, we take it as it is, and we can expect, for example, that the monthly data, housing, water, and fuels, they should be here 0.7%, 0.6, 0.7, and somewhat negative in the back end of the year. Same for electricity, gas, and utilities. They should eventually follow step down, not step down, but decrease somewhat. It's not very precise because we are seeing here a decline of -4, -5%, -12%. These are very large. So it should absorb back the high costs that they have been charged all full throttle 2025, 2026. But by no means this is not related to what other people would do. Okay, so RPI, this should be around 2.5%, 3%. This is not very well connected. So here RPI food should continue declining towards the 1%. So eventually the ARMA model gives me that food prices should continue going down, become less and more affordable. RPI, all goods in general, also goods prices should be around 3.3, 3.2, 3%, 2.8% by December. This does not take into account, for example, the seasonal effect that any consumer can see every year when it's the shopping season, in December especially, prices going up, jumping, because there is a spending spree. But what I noticed into the data is that the inflation measure of household expenditure in the UK has been declining. So that basically is a counterbalancing sign or data that proves the fact that because there is an affordability problem, okay, I don't want to say crisis because we have the word crisis is very much inflated, because there is an affordability problem which is widespread across the income spectrum. We can observe into the data that the household expenditure inflation measure, it has been decreasing. So it means that demand has been cooling down because prices are still high and it's difficult to afford those level of expenditure even when prices still keep going up. And when you have housing related expenses, which are utility bills going up, then you have to cut on spending, which is shop services or retail or leisure time or the usual things, or buying clothing, so forth and so on. So I want to recover I want to visualize the percentage, the household expenditure. Percentage, all percentages. Okay, here we have it. So we jump back on to this one. So the retail price index of I don't need this. Okay, now housing and household expenditure over 12 months. If we scroll down quickly here, okay, we can see here that we are having reads of 2.1, 1.9, 1.9. And household expenditure was actually good. And it kept up with the business cycle here, okay, of the previous fiscal year, okay? So if we go and crisscross we see here that we have solid household expenditure for 2024, 2025, that's a retail price index. So we are above 2%. Here we have 4.4, 4.3, 3.8. These are April 2025. So we have a 5.6 strong housing and household expenditure, 5.5, 5% stuff, 4.7. But in the latter period, so in the first and second quarter of this year, 2026, we see that we are declining 3.5. Then we have here a repentinous drop off of 2.1, 1.9, 1.9. So we can sort of link all together that the household expenditure side kept pace with the rising cost of household bills and the rising prices. So statistically, housing and household expenditure, it has kept up quite solidly. Okay, these are high numbers. They are above 2%. They are nowhere near the 2% price stability criteria. But we see here that the household expenditure measure in the retail price index thing, it's declining below 2%. So there is a pushback from the household expenditure side, which can tell us that there can be a cool down in the availability of the consumer pockets in going out and splurging the cash. Okay, very trivially put, but it's an important thing to consider, that it's a trade-off that we have to consider, because we have the usual condition, which is typical of the UK economy, of household expenditure, which has to go through a higher an inflationary environment, which can be sort of stagflationary. In what sense? We have the slowdown in productivity in the UK is a direct function of businesses having to expand their inventory, so they have to stock up more goods, and so they tend to produce less domestically. Okay, why? Because there is frictions in the movements of goods at the border. It has been decided by the UK, and so what happens? The businesses, they have to stock up with stuff. Okay, this was very much a problem immediately after 2022, 2023, and then slowly it has been tried to smooth it out, etc. But let's see if I can do a squiggle here. No. Okay, so I will share with you what happens is that the business, on the business side, okay, if I have a business here, and here is the water, or here is the airport, okay, and I have to receive my inputs, okay, what happens is that I want more inputs, because this stuff, when there was the just-in-time supply chain, okay, it will take 1 day, okay, to clear off, maybe half a day. But now, when after Brexit, we have that to clear these things, okay, it takes not, it's not a conditionality or anything. It takes, I don't know, between 1 day and 1 week, okay, between all the, and then there is an additional plus red tape border checks for goods, okay? So what happens is that the business, what does? Instead of asking for 100 pallets, okay, they say, okay, give me 1,000 pallets, because if I cannot have 100 pallets that are cleared in half a day, so I need to stock up my merchandise, because I don't know when the next lorry is gonna come, okay? And so when I have 1,000 pallets here, what happens? That inventory goes up, but production goes down. Domestic production goes down, which means that productivity, the TFP, total factor productivity, goes down. So a direct consequence of choosing to put a barrier on the just-in-time supply chain, it has automatically damaged the total factor productivity of the economy. This is actually verifiable in any economy textbook. If you take the UK data, you see that the total factor productivity, it has basically flatlined, okay, especially since after the great financial crisis. But the big issue, it has been to go for Brexit, which is a total disaster, okay? It's not my personal concern, it's that empirically, materially, by all angles that you consider these things, it's wrong. It's the wrong economic policy. It's idiotic. It's stupid. Okay, I don't want to be offensive, but what I'm trying to say in very plain, polite, and conversational manner is that when it's empirical economics. So when the business, they have to stock up more merch, right? Because there is all this problem, we don't have just-in-time supply chain, and you have to reroute. Even if you say, okay, I want to import stuff from Asia, from Africa, it's stuff that comes from China. Okay, if you order on fast fashion on Shein, Temu, so it takes a week. So it's the same criteria. If I import stuff from the United States, or from China, or from Australia, from India, it takes between a week or 10 days. So I'm not gonna ask for one box. I'm gonna ask for 100, 1,000 pallets, I don't know, for as much as I can, because it takes a long time. And so it's a break in the supply chain that basically stops the productivity within the UK. We don't want that. It's a choice that the British people have made, or that the you Brits have made. So I'm trying to explain you that if you miss stuff on the shelves, it's because you have chosen to do that. So the just-in-time supply chains allows the productivity to go smoothly, because you have goods coming in and out all the time, and so you don't have shortfall, you don't have breaks in this, in the supply chain, in the supply of stuff that you need, and so you can keep producing, doing all the things that you want to do. I don't give a damn, but you can do it. So I'm more concerned myself that the Brits are. I don't know. It's quite bewildering. But from a macroeconomics standpoint, is that the productivity goes down because businesses, they stock up on inventory, so they don't need to produce that much because they import more, sort of. Okay, they can import more from Asia, but because it takes 7 or 10 days, and now there is the Strait of Hormuz, so nothing goes through, so it's going to take longer. Okay, so the just-in-time supply chain, it's a great thing. Yeah, I'm not saying it's perfect, but it worked marvelously for UK PLC, because you are able to get your goods anytime, no problem, smooth moving around. There is no paperwork. So just go in and out, no problem. That's it. And the business cycle goes, the production of manufacturing, or food, or anything that you need, services, all sorts of stuff. Heavy industries, engineering, I don't know, if you are producing machineries, whatsoever. You need the stuff, you call it in from wherever you like, from the Dutch, from the Germans. You need some machineries to, I don't know, do some heavy industrial work. You get it in a day or something, and then you start going, and you keep going. But if you need to ask for something, and then you have to wait a week or a day or 10 days, and then you will not ask for one thing, you will ask in bulk for a loads of stuff, you stock up, and then you stop your production. So that's one thing I digressed on, but it's important. So here we have, I don't know why I jumped on the total factor productivity, but it's important because the just-in-time supply chain, it's a good thing for the productivity of the UK economy, which means economic growth, which means jobs, which means wages, which means a better life. I don't know, easier. Okay, not so many problems. Then, other than presenting in a sketch the real evidence, which is basic common sense. Okay, you ask to any business in the UK, they tend to stock up more because there is this problem of goods moving in and out, and then the consequence is that the productivity suffers. Okay, you cannot be so much productive if you have an interrupting, or you have a slow supply process. Okay, and then maybe you have shortages of things. Okay, that's basic common sense. That's it. So, okay, I apologize. It jumped. Right. No. Hold on. Bear with. Where we are with this. Okay, we are here. Okay, so we have RPI. Let me go up. RPI housing. So housing costs should be going up towards 4%. So housing and household expenditure, it should go pick up a little bit again towards the 2.5%, perhaps tracing back the seasonality of the shopping season. Then here we have the big thing. We see that petrol prices, they've gone to 29.6%, 30%. Okay, diesel, petrol, unleaded, whatever you call it. it's at the pump 1.6, 1.7 pound, around that level. So we have here the 21, 23, 24%, 22, 21% RPI rate. So we are talking about the 20+% RPI rate for fuel cost, which is a huge cost that will basically constrain the ability of spending on other things. And it goes through the economy and then through economic growth. Shop services inflation should be around 4%. I don't know. I'm not so sure. Okay, housing and household expenditure. Yeah, that's the same data column that we had before. So RPI, all services are projected to go up again towards 3.5, 3.7%. So the services sector could see rising inflation, CPIH converging towards 2.6, 2.5. Core CPIH should be stable around 2.7%, 2.6%. CPIH services around 3.5, 3.7%. So as you all can see, all these projected forecasts, they are not converging to 2%. CPI index services, okay, 3.5%. So these tendentially, not tendentially, in practice will be a macro data factor that the Bank of England will have to take into consideration quite carefully, because not only for the price stability reason, okay, but also because if the Bank of England is not able to diminish the cost of borrowing, this basically keeps a sort of let's call it vicious circle into the economy. If we another basic common sense. So here we have okay, let's put the pen. Here we have the old lady. Okay, we have the old lady, the BOE. Okay, so the BOE basically say, okay, I am. My bank rate is 3.75%, 3.75. So the BOE basically, the transmission mechanism goes to the commercial banks. Okay, so there are the big four, big five, whatsoever. You all know there are Lloyds, NatWest, Barclays, HSBC. Okay, so if their cost of borrowing is 3.75, they will pay, let's say, 3% to depositors. Okay, so we have I of D, IR of D, so the interest rate for depositors. What happens? This big four, it's it's not that nice. Big four. Okay, so here we have IR of D for depositors. Okay, let's say it's 3%. You park your money on your current account, and oh, it's not recording. One second. Great, we're back. So I was saying that this inflation data trade-off decision, it's important for the Bank of England and for inflation itself. Why? Because as I was saying, okay, we have here the old lady, the BOE, old street, old lady BOE, and she says, okay, my lending rate is 3.75%. So how goes the transmission mechanism? Is very simple. Anybody knows that. So the BOE transmits, let's say, the money, let's say, to commercial banks. Okay, commercial banks, they have their money already. Okay, they don't need the BOE. So, and it transmits money to HM Treasury. Okay, to H&M Treasury, HMT. Okay, so the cost of borrowing for public and private sector. What happens that the commercial banks, they say, okay, if you park your money here, I will give you 3%. And here we have the IR of the depositor. Okay. But what happens if I am a business? I have a PMI, I want to open a coffee shop, I want to sell donuts, I want to sell cookies in a food stall, I want to have a vintage shop, a vintage clothing shop, I don't know, I want to open a travel agency, anything, okay? You want to run a business. What happens that you have not the central, the commercial banks, which are the big four, okay? These are the big four big four, okay? They say, okay, but I can give you this money. So the IR of B of the borrower, it's 6%, 6.5%. Okay, if you are a good borrower. If your credit rating is not so good, perhaps I will ask you 7.5 or 8% whatsoever, or etc. 7.5 plus. So let me, okay, yes, this is much better. Okay, so why this fits through into the economy? Because if I am a PMI here and I am the borrower at 6.5, this goes, I am PMI here, I receive this from the commercial banks, from the big four, Big Mama gives an interest rate of the borrower, which is 7.5, and this goes here to the consumer. Okay, so what happens that the price goes up into goods, consumer goods. Okay, so inflation, sorry about that. I will do a pi for inflation. So, okay, we call inflation pi, Greek pi. Inflation goes up because it comes straight back up from the credit channel. Okay, so inflation goes up and the Bank of England is stuck here at 3.75, and it can't cut interest rate. And so on the other side, you have the nutters in Westminster. Okay, please don't be offended. You have the people in, you have HM and Treasury, or the bond markets, what they say, the bond markets, etc., which ask the yield goes up. Okay, so it's a side effect. It fits into the cost of borrowing also for the fiscal capacity of the government to do what they want to do. Okay, so that's why the cost of borrowing fits through fits back through into consumer goods, and also in inflation when it's mortgages or anything that you're paying back. It can be auto loans, credit cards, consumer credit loans, anything. Okay, it fits back through. It goes back into the ordinary person. Whether it's taxes, they know where they go right back to somewhere, which is always the same group of people, which is the ordinary folks who go to work and do their own stuff, or people like me who do that work on YouTube, or they have digital services, that sort of things. So that's a very interesting nonetheless, because it's based on interest rate. It's a very interesting mechanism, because these basically can be what happens here. We go in a thing that the business of the big four. Okay, now I'm diverging. We are big four. We are done for inflation. Then I will do another video with the other models. The business of the big four is basically to have the IR of the borrower, okay, always bigger than the IR of the depositor. Okay, so they pay to your current account 3% if they feel generous, but they charge 7% to the borrower. So 7 minus 3 is 4. Okay, that's the net interest rate margin that the banks bring into their pockets. This business, it's worth for the UK, which is called Seigniorage, Bank Seigniorage, it's plus 20 billion pounds per year. This is the main business of the whole of the situation here. Okay, so why I am bringing up this this nice sketch and I hope you enjoy it. Because without inflation, what happens is that the rate of borrow will be marginally lower. So the margin of business of the big four will not be so fat. Okay, so it's a very difficult thing that the Bank of England has to decide. Okay, because the Bank of England makes 4 billion per year in issuing money, basically just in providing pounds. The cost of digitally creating money is zero. They earn from the gilts, from the bond market. So with something that costs zero, which is creating money, they both, with quantitative easing, they bought from HM Treasury, the debt management office. They bought the bonds, okay, and so they earn on that. And so this whole operation, it makes 4 billion per year only to the old lady of Threadneedle. That's the seigniorage. And this goes, it's the same anywhere. It's in the ECB. The ECB has a different system because the ECB, the money that they get, they redistribute the money to the national central bank, and the national central bank, they pay back those money into the fiscal, to the treasury. Okay, I don't know what happens with the Federal Reserve. I haven't researched the exact functioning about that, but they print money, they create money digitally, and they make a profit. They should make a profit. So this whole circle, basically, this whole thing, Bank of England, commercial banks, PMIs, and consumer, it's all based on inflation and IR, interest rates. So inflation, it has to be somewhat always more than 2% for the big four to bring home this 20 billion plus per year. So the Bank of England will never ever achieve 2% price stability because it's not in the business model of the Bank of England and of the commercial banks. Okay. Then we can diverge and say you have to tax the banks, no, so forth. No. What I'm saying is that it's very simple. What I'm saying is that the core inflation target of 2%, okay, it's for the birds. It's bollocks. They don't want. It's only a thing that they talk about when they do the Bank of England press conference, when they decide what is the level of interest rate. But any ordinary person, it doesn't matter. It doesn't really matter because it all goes through the commercial banks. But the commercial banks, okay, when you go to a commercial bank, okay, you go to a commercial bank, okay, you go to a commercial bank, you go to Lloyd's. I need the money to finance my buy-to-let business. Okay, so Lloyd's basically, it creates money from the ether, from nothing. They create the borrower account, and they credit, I don't know, 400K for your buy-to-let business. And you are the borrower, and you pay back Lloyd's. But these are digital money, which to Lloyd's cost zero. And then they receive the IR, the interest rate of the borrower. This is the business. Okay, Lloyd's does not need to ask the Bank of England. This channel does not exist, but it's not necessary. The commercial banks, they create credit willy-nilly, okay, because they have seigniorage, they have this ability, they have this right of creating money from nowhere, and they earn on selling money. Okay, they are depositors of your money, and they lend money. Okay, but when they lend money, they don't necessarily move the depositors' money. They create the borrower account, ACC. Okay, they credit digitally 400K, for example, and the borrower has to pay back every month the docking bill, which is interest rate plus something. Okay, And that's how it works. This is the whole business, and it brings in plus 20 billion for the big four. And this needs inflation. That's why you have inflation in the housing sector, because there are people who are borrowing, and all this thing is called financial friction. Friction. What's up, Emma? Okay, that kind of thing. Financial friction. Okay. Which, if we sum up the financial friction with plus supply chain friction, okay, this equals inflation. High inflation all of the time. So this is the biggest, not the biggest, the main characteristic, structural feature, as you want to call it, for the UK economy. Basically, after studying so long time, I knew these things before, but it's funny to do a sketch so that you can see on the screen. And yeah, so that's basically why inflation, the pie, it's all the bake me a cake, right? Bake your cake and eat it. But the pie, it's for the banks, for the Bank of England, or it's a bit less for politicians, but it's for the banks. And who pays is the consumer, or is the borrower, basically. Okay, so Brexit is definitely not a good thing for any ordinary person. Okay, I'm trying to be as much objective and less biased as possible, because I'm describing the same that I've described you what happens everywhere in the world. So inflation, it's a feeding effect on itself, and it comes also from the credit channel. Okay, inflation comes from financial friction, supply chain friction. We have inflation. Okay, financial friction is the borrowing cost. Okay, so these are the dynamics basically sketched on an iPad. Okay, and that's why I can do all the multimodal inflation forecast, and if core inflation will be, say, I don't know, plug my finger up in the air and say what direction is blowing the wind, and say, okay, no, it's 2.8, 2.7. But the main fact is that the BOE in reality does not want inflation to go to 2% or below, or undershoot, because it undermines the business. But then what it basically, you end up in a debt deflationary recession, which is another kettle of fish. Okay, so here I have other loads of models, which are ARMA, SARMA models for all the other things. But basically, the main takeaway is that when it comes in 2 days' time, Wednesday, today is Monday, I do not expect, okay, the consensus is 2.9%, but we saw that basically the big effect, it's mainly in energy prices, or what ordinary people do know. So it's housing, house bills, water rates, gas, electricity, diesel, heating oil. So this that does not push up a lot the overall CPI or CPI rate, because the core inflation measure, it's a measure that strips out the energy or food cost. So they are not into core inflation. Okay, so core inflation, it's important to watch because it's strictly related to services. Okay, this year, in fact, that services, CPI services year, it's 3.6, which is okay, it's 1 point above the core inflation. Okay, so what push a lot core, it's services prices. Okay, which is still higher than 2%. But services, they all reflect into wages of the services sector. So when you have the economy that is skewed to the services sector, if this one what happens? Let's do another thing, okay? Let's do it here, okay? So we are the consumer which pays pays for the pie, but basically we earn wages from services. Okay, so what happens when the services inflation goes down? You have to immediately look for earnings and wages and bonuses paid, because when wages services, okay, no, okay, it doesn't matter. What I'm saying is that when the index of services goes down, wages go down, services CPI goes down. So when this rate of inflation, this one on the screen here, okay, decreases, the transmission mechanism goes through wages, okay, and so it goes through consumption, goes through GDP. So there are lots of moving parts. It's very interesting, but the way of looking at inflation, okay, because inflation, they are prices, but they feed also into wages, okay? The cost of a plumber, the cost of a carpenter, the cost of, I don't know, anybody who provides some sort of services, garden, catering, whatever you call it. And so when the CPI index services goes into deflationary mode, you would see immediately that wages, they start to feel the pinch of less earnings. So this is a different, not a different, but perhaps a different angle of how to see inflation, because inflation is necessary for interest rate to be at a certain level, because the banks need to print money and to earn from the interest rate of the borrower. But we have the services industry, so inflation in services, also it's a component of the wages in the services sector, and so they feed through each other, okay? So if I spend money in services, those go into wages of people working in the services sector. And so inflation is a necessary thing, but what it's important, okay, and I was missing the point here, is that, for example, when services CPI, let's argue that I have services here, CPI, okay, goes down, wages goes down. So what means that total factor productivity is decreasing. And so GDP, okay. So inflation index of services, it's also can be an indicator, a cofactor, not an indicator, a cofactor, which is more precise, of the wage component that goes into total factor productivity and ends up into the GDP figure and into the real business cycle, okay? But again, the main thing is that the real business cycle of the British economy is strictly linked to this thing: financial friction and supply chain friction, okay? These are dampening effect on the total factor productivity. So if you don't have these two, you are able to have lower inflation. You are able to have inflation stable, okay, inflation going down, and TFP, total factor productivity, going up. Because the economy, it's more, the business cycle is it's balanced. You are not buying for goods, bidding for goods. They are very expensive. And so you don't have a high borrowing cost. This is the case of the Eurozone. You have lower cost of goods, low inflation, you have low financial friction, and so you have a stable pie, okay, it's stable. And so total factor productivity can goes up, okay? It's not stagnant, okay? It can be stagnant for the opposite reason, that inflation is dampened, and so you have low prices, and so you have low total factor productivity. But the secret sauce is in stabilizing prices. That's why we have price stability. If we have a stable pi, inflation, we can have a stable total factor productivity and gross domestic product and real business cycle. But if we have these problems here from the beginning, that inflation starts here with supply chain and financial friction, and the financial friction starts at the top here in this situation here, starts here, the financial friction starts here, financial friction starts here at the credit channel transmission mechanism with a big force supported to the borrowers and the PMI. That means that there will be always high inflation, an average 3% inflation. So pi will be always 3%. 3%. That's the main takeaway. Okay. The main takeaway is that the average inflation cost is 3%. Now, let's do an experiment, okay? If I do average, if I do average the column here, and it's 4%. So from 1989 to 2026, the average inflation rate in 37 years is 4% for the services index. It's twice the 2% Bank of England price stability mechanism, okay? Not mechanism, price stability mandate, okay? So if we go to the CPI column, let's see, this will be perhaps 2%, let's see, average, it's 2.8%, okay? It's 2.84%. So it's 2.8%. In 37 years, CPI, the average is 2.8%. And this basically, it's the markup, it goes into the credit channel. It goes into the cost of borrowing. It goes into the business of the bank Seigniorage. Okay, they provide credit to PMIs, borrowers, and so they need inflation to justify that your cost of borrowing of your mortgage is 6, 7, 8, 5, 6, 7, 8%, 10%, whatsoever, or your credit card is 20% interest rate, APR, and so forth and so on. That's why now we will do all columns here. We will see here, okay, this, what? No, there is a mistake here. In fact, this sum is not average. Average the column, my friend. Ref. Okay, no, never mind. Okay. Not sum. Average. Okay. This is 4%. Okay, now redo average year. Average core CPI 2.5%. So it has never been 2%, always a little bit above 2%. So the monetary policy discussion that the Bank of England does when they do, even the ECB, the Federal Reserve, it's basically has no credibility at all in whatever they say. Nobody believes them. Here, okay, CPI annual rate, the average electricity, gas, fuel, 5.68% on a 37-year horizon. Okay, so the average inflation rate for electricity, gas, and other fuels, what is bills and utilities, it's 5.7%. Okay, it's not 2%. So this stuff goes all into wages, business profits, borrowing rates when it's for banks, but all the averages that we've done here, CPI, core CPI 2.5 is the least bad, but CPI is 2.8. Okay, and here housing services 3-4%. As we move into the housing sector, we go to 4, 5, 6, 7%. Because all those measures which are not the sum, the average, okay, all those measures which don't come up on the telly, basically they don't report it properly. You have to go and look for the statistics. So you can all see that these are all way above 2% for this all sketch here in the iPad. So what to expect? As I said, I would not expect any particular surprise. Perhaps consensus is what it's perhaps the nearest thing that could be 2.6, 2.8%, because CPI on average it has been for 30 plus years 2.8%. We can expect that inflation rate will be 2.8%. Okay, so we are there. We are in the ballpark of this. The problem as we all know, it's for the cost of fuel, petrol, housing, utilities, water rates, services, so forth and so on. So I hope you enjoyed the video, and I hope you managed to watch it all. Next time, as soon as possible, we will see the modeling here. I will show you some more complicated things, but not so difficult, stuff. But anyway, thanks a lot. I hope you enjoyed the sketch here and all the stuff that I have tried to convey to you in writing here. And yes, so thanks a lot, and see you next time.